Wall Street has felt some relief as the U.S. Treasury yields eased, following the Treasury Department's move to inject more liquidity into the long-term bond market. For more on this, we invite our Kim Bo-kyoung into the studio. Welcome back, Bo-kyoung.
Thanks for having me.
Bo-kyoung, first things first, the Trump administration had to step in as the bond market sent a warning signal. Now, what did the Treasury Department announce?
Right, so after long-term Treasury yields hit their highest levels in years, the U.S. Treasury said on Wednesday that it will at least double its buybacks of 10 to 30-year treasuries. Each purchase will increase from $2 billion to at least $4 billion temporarily from September 9th through November 4th. Long-term Treasury yields had soared to 19-year highs on Tuesday, with the 30-year yield hitting around 5.33% and the 10-year yield topping 4.7%. Well, after the announcement, the 30-year yield fell as low as 5.18%, while the 10-year yield dropped to 4.63%. This fall led U.S. stocks to close slightly higher on Wednesday, with the Dow up 0.22%, the S&P 500 0.21%, and the Nasdaq 0.16%.
Then, Bo-kyoung, what drove the recent surge in the yields?
Right, so the sharp rise in long-term Treasury yields came amid growing concerns over inflation, fueled by prolonged conflicts in the Middle East.
Because the conflict in the Middle East remains at stalemate and oil prices are going up, there's an expectation that inflation is going to be higher for longer, and that's going to further erode the kind of returns that bond investors are used to getting.
Well, investors are also demanding higher returns amid ballooning government deficits. According to the U.S. Treasury Department on Wednesday, America's total national debt has surpassed $40 trillion for the first time. Well, that's up from $30 trillion in January 2022, less than 5 years ago. And another factor behind the global bond sell-off is the AI investment boom. Major tech companies such as Microsoft and Meta are issuing massive amounts of corporate debt to buy NVIDIA's AI chips and build data centers, competing with government bonds for investor capital.
Well, Bo-kyoung, the market has cooled down a bit, but many experts see this as a short-term fix, don't they?
Right. So one expert I spoke with also said that the U.S. Treasury's buyback is not going to be the fundamental solution. Let's take a listen.
There's still a great deal of uncertainty and concern in the market over these bonds. Therefore, unless the U.S. government introduces a bold policy, I believe there will be a limit to how much Treasury yields can come down.
Well, another expert said South Korea's long-term bond yields could also rise as investors keep a close eye on its fiscal deficit and national debt.
Korea's government debt is perhaps lower than other countries, but government deficit is very high and debt is increasing. So international investors have reasons to be nervous about Korea.
And when it comes to the impact on stocks, the same experts said rising bond yields would normally weigh on the market, but the impact could be limited for now due to the AI boom and strong demand for semiconductors.
For the exchange rates and the stock market, because these demand for Samsung Electronics and Hynix, the semiconductor producers, are just so strong, and they do not seem to be affected by what's happening in the government bond markets. I expect the Kospi numbers, the exchange rates, to not respond that much to what's happening in the government bond markets.
So basically, without semiconductors, the factors we discussed would likely weigh on the Kospi. But with semiconductors in the picture, the market is likely to be driven largely by demand for chip makers. So we'll have to see how it plays out.
Indeed, that is all the questions I have for you, Bo-kyoung. Thank you for the wrap-up.
Thank you.